We'll go ahead and get started. I want to make sure our panel has their full hour to cover this important topic. Good afternoon. My name is Paul Hupfoff. I'm with MD Resources Group, and I'm based in Glendive. I've been on the Montana Chamber Board of Directors for the last several years, and I currently serve as the Vice President of Finance. Montana's tax structure has and continues to be a topic of great discussion among policymakers and stakeholders. The conversation about taxes appeared to intensify in the aftermath of the November 2017 special session. That same year, the Montana Chamber commissioned an analysis of our tax structure to better understand the pain points, especially as it relates to the business environment. The State Tax Research Institute, an affiliate of the Council on State Taxation, has worked diligently for more than a year to produce the results that will be shared with you momentarily. Research like this is the cornerstone of our 10-year strategic plan and Vision 2026. With that, I welcome you to our panel, Crunching the Numbers, Solutions for Montana's Tax Structure. I'm pleased that we have with us two tax experts who have made the time and travel to visit with us on this important issue. And I'll refer you to the event program for their impressive and very impressive bios. But in short, we have Bob Klein, a PhD economist and co-founder of the Tax Sage Network, a retired Ernst & Young economist. He specializes in economic analysis of state and local, federal, and international tax policy. He and his fellow economist, Tom Neubig, are the primary researchers of our analysis. We are also joined by Nikki Daubé, Senior Tax Counsel on the Council of State Taxation. Based in Portland, Nikki consults on Oregon tax, state, local, income matters, multi-state tax issues, property tax incentives, and much more. She is a former manager for PricewaterhouseCoopers. Please help me welcome our esteemed guests. After our remarks, we'll open the floor for questions. Bridger Malum, our Government Relations Director, will have a roving mic, and he'll pick up all of your questions.
Thank you. Oh, there we go. Now we're on. Bob said that he was going to deputize me as an economist, which is a little scary. You should know I did none of the math in this. I am definitely a lawyer by trade.
The reason for making her an honorary economist, you are about to undergo an unusual ordeal. Some might say cruel and unusual punishment, listening to economists or honorary economists for 2 consecutive hours after lunch. But we hope we'll have something to say of interest to you.
Yeah, also by deputizing me an economist, I can't use any of my really great tax jokes. No, I promise to work those in if I can. But we do have a lot of information to cover. I'm going to start off by going through a cost study, which we put out every year, and really focusing in on Montana and the business taxation situation here. And then Bob is going to get into a discussion of a competitive analysis based on the current photo that we've taken of the tax structure, and then we're going to be talking about some tax reform options. So I am not sure how many of you, if you want to move one more, ready for that one. How many of you were at the Montana Taxpayers Association's meeting last month, where Doug Lindholm, our president, the president of COST, came and spoke. I asked him if he covered the cost business tax burden study during his presentation at that meeting, and he couldn't remember, and so he said, even if I did, I suspect anyone else in that room doesn't remember either. So we'll see if our figures match up for those of you that might remember some of that. But so each year, COST puts out what we call our business tax burden study in conjunction with Ernst & Young. And what this study does is it takes a look at all of the state and local taxes paid, and then really focuses in on the state and local taxes paid by business. Why do we do this? Well, going back to the early 2000s, there was a lot of rhetoric going around about business not paying its fair share when it comes to taxes. And which was very interesting because Bob knows this, and I know this as a state and local tax person. Businesses spend a lot of time thinking about taxes, not that they want to, they just have to because they actually do pay a significant amount of taxes. But where all the rhetoric was really coming from related to the corporate income tax. And this was an economic downturn during this period, and there were several policymakers in certain states really saying that business didn't pay any tax, but they were always focusing on the corporate income tax, which of course business doesn't pay a lot of corporate income tax during an economic downturn because of losses. And that's exactly how a corporate income tax is supposed to work. So what Cost and Ernst & Young set out to do was to really take a picture of what are all the other types of taxes that business does pay, and let's try to educate policymakers that business is really paying their fair share. We just recently, in last November of 2018, put out our fiscal year 2017 business tax burden study. And for that fiscal year, business paid over $738 billion in state and local taxes nationally. I'm going to say that one more time, $738 billion. That's almost as much as the national debt, if I was listening properly to the last one. So business is paying a lot in state and local taxes. So how does that break down? Now, you guys can cheat and look at the slide, but what do you think the largest chunk of tax paid by businesses, what type of tax is that? Who would say it's the corporate income tax? Oh, good. We've got some great people are paying attention. It is actually the property tax. You can see there nationally, business pays about 39% of that total business tax burden is property tax, followed second by the sales tax, which is 21% generally, or according to our U.S. national average. It isn't until we get down to that 9% number, that's the corporate income tax. So of the business's total state and local tax burden, in general, a business pays nationally, multi-jurisdictional business will pay about 9% in corporate income tax. How does Montana differ? Here, Montana's picture is significantly different from that U.S. National average. And why is that? Well, Montana is one of those special states in the state and local community that we refer to as the nomad states, which means you don't have a sales tax. You and 4 other states do not have a statewide sales tax. And so that big 0% on that second line is one of the pain points for you that we'll be talking about. And so you say, okay, this 21% in the U.S. national average, what does that really mean? Are we just talking about the collection of sales tax by business that they then remit over to the state? No, that's not what we're talking about. That 21% number really reflects the sales taxes that businesses are paying for their own consumption of inputs, or their own consumption in, printers, copiers, paper, things that they're using within their business. Business, on average, pays 21% of that total pie. So that's one area where, without a number on that second line, Montana has to make it up somewhere else in revenue. And so you really do that in a couple other spots. I'm going to go all the way to the bottom line, that license and other tax numbers with the asterisk. That is where we pull in your severance taxes. So you do have natural resources here, and severance taxes are paid on those natural resources, and that does help you out a little bit with filling in that gap. But then you have to make it up. It doesn't fill in that full 21%. So now we go back to the top of the list, and that 51% mark is pretty outstanding. That is definitely a number that is tough on the business community, and one that at Cost we definitely hear about from our members, that the property tax burden is pretty high here. Bob, before we move on, anything to add?
Nikki, I would just add that when you look at that, the property tax piece, Nikki's point is that the missing 22% of the pie that would be state and local taxes, the missing consumption piece is forcing Montana to rely more heavily on two things: other taxes and more volatile taxes. And so you can kind of see the pieces coming together. The volatility of the Montana tax system is like the 38% above the volatility of the average state tax system as measured by your Department of Revenue. I think it was in a biennial report. So it is. So what you get are high marginal tax rates on some of your other taxes, which discourage investment and economic expansion in the state, and you get greater volatility of the overall tax system. It's like the worst possible combination you could think of. And so we'll talk further today, more than we have in earlier presentations here, about the policy implications. What does a better tax system for Montana look like given those issues? But you can kind of see the issues unfolding in this one table.
And so this next slide, and I am going to ask for Bob's help on this because this looks like an economist slide, because anytime numbers start getting over 100%, you lose me. But I'll stick to the first column. So here, the first and second column, here we're really trying to take a snapshot and dig a little bit deeper into those business tax numbers and where are those going. So in Montana, you have 41% going to state level taxes, whereas the national average would be at about 38%. For local taxes, businesses are paying about 63% to those localities, with 52 being the national average. Again, this is really reflective of those high property tax numbers with respect to the local taxes. And then again, that total state and local tax burden is 49% on business. The U.S. national average business generally pays about 44%. So Montana's in a bit of a different situation than many states in the U.S. where individuals are paying a greater portion of state and local taxes. In Montana, they're actually, reverse that, they're paying a slightly lower percentage. So going down to the last number, for cost study, what we try to do in order to compare the states at the end of the day is provide this total effective business tax rate. And what we do there is we total up by state all of the state and local taxes paid within that state, and then divide that number by the state state GDP, or the state level kind of production. And here, when we do that in Montana, we come out with a slightly higher effective tax rate. So Montana's is 5%, whereas the national average is 4.5%. I was, before this presentation, looking at our most recent business tax burden to kind of see where Montana was just with respect to the national average. And there are states that are definitely higher than Montana with its 5% rate. Those states are also states where they are heavily reliant on severance taxes and natural resource taxes. So when Montana is compared to other states situated like that, it does appear a little bit lower, but this number is still high relative to the national average. And Bob, if you want to explain that last column.
Well, that last line, that effective tax rate, was our effort to try to give you a single measure of how high business taxes are relative to private sector economic activity. And while Montana is only a half a percentage point higher than the U.S. average, that's a big difference by this measure. This measure tends to group pretty closely to a center number. In fact, the fact that Montana is 111% of the average, 11% above the average, puts Montana tied for the 12th highest effective tax rate on business of all the states in the United States. Part of that's due to the heavy importance of the property tax. And in terms of maybe the talking points with legislators or numbers that legislators might want to focus on. I have three from this slide. The first is Montana businesses, according to the latest cost study estimates, pay $2 billion a year in state and local taxes as taxpayers themselves, as entities. They pay 50% of all taxes in Montana. And almost 50% of the business taxes are the property tax. It's 47%. Because Montana's had to push the property tax so much to make up for that missing leg of the three-legged stool, the consumption tax, you've got a progressive property tax rate structure, which is almost unique in the United States, and you have relatively high reliance on the property tax to finance local governments. And so that combination is what's giving you the result of $2 billion of total taxes paid by business, 50% of all state and local taxes, and 45% is from the property tax.
There we go. And so, not to belabor this point, and this slide is really meant to just kind of re-highlight some of these pain points. So looking really, focusing on the second and third bullets, Montana's business tax structure, the main pain points are the property tax, but really tax rates, personal and corporate rates, are higher than many other states. So those could also be reduced to make the state more competitive. We also found that capital investment within Montana is heavily burdened. This comes in two ways. The first through the property tax, and the personal property tax structure, and that does impose a burden when people want to make capital investments here. Also, when we look at the corporate income tax, Montana is one of very few states that is still a three-factor apportionment state, which means that property and payroll are also considered as part of your apportionment formula. As a disclaimer, cost does not take a position on single sales versus three-factor apportionment. There are winners and losers, but what a three-factor formula really does is imposes a burden on your in-state companies because they've now got to take into consideration the property that they have here and their investments here when they're determining what piece of their income tax pie they have to pay to Montana. Multi-jurisdictional companies. So really, those are two areas that we've highlighted as the pain points.
And I could just add to Nikki's comment about it's the combined effects of the business taxes that matter at the margin as an investment incentive. And as the prior speaker noted, it's all about productivity. The future is all about productivity, and traditionally the driving engine behind productivity is increasing capital per worker. Increasing capital per worker is another name for investment. And the fact that the current structure is working against that incentive to add to the capital stock and increase productivity in Montana, I think is a real issue for the future. Now's not a bad time for Montana to consider other options in terms of tax reform because you're doing well economically. There's no better time to tackle a tough issue like reforming your current tax system when times are good as opposed to when it's raining heavily. So the timing, I think, is good for this discussion.
Yeah, and the other thing I would add to that is with the federal tax reform, which happened last year, the end of 2017, during this legislative session, Montana's, because it's a rolling conformity state, you are going to have to dig in and see if there are issues related to federal tax reform that you may want to specifically decouple from. So this also is a good time to think about these other issues. And when thinking about federal tax reform, and one of the goals of federal tax reform was to make the U.S. a more attractive place for foreign companies to do business. With our high corporate rate previously, the U.S. was considered closed for business. Now that that rate has been lowered, the U.S. has a big "we're open" sign. And you know, one thing that I've been stressing to legislators in many states, especially in states that are particularly business friendly. I live in Portland, so I spend a lot of time in California and Oregon, and you may be shocked to hear that they're not super business friendly. So they don't always respond well to these thoughts. But in those states that I do work in that have an eye on attracting investment, this is a perfect opportunity for Montana to make itself an attractive place to do business. Because if a foreign investor is coming to the U.S., they've got 51 different places to decide whether or not they're going to do business there. And some of them they can immediately cross off the list because of how unfriendly they are to business. But there are several states, particularly kind of in this stretch of the country, where they've got some decisions to make. And as Bob said, it's these small things that can be very important when they're coming in and deciding which state to set up shop.
Well, I'd like to pick up the discussion at this point by looking in a little bit more detail at some effective tax rate calculations that we've talked to this members of this audience have heard some of this before. But what we did is we said we wanted to look now at the individual firm perspective. Let's look at typical or hypothetical companies and see how the current tax structure in Montana affects them and affects their competitiveness compared to selected other competitive states. And so we were asked by the Chamber to, and in discussions with the Chamber, came up with 6 different types of industries. One's a pass-through entity. The rest are C corporations, and they're in different industries that we'll talk about briefly. But we took those 6 hypothetical taxpayers, we put the same, created the financials from IRS data, so we've got balance sheets and income statements, and then we put that same operation in all of the competitor states. We looked at 6 other states in addition to Montana. So the financials are held constant across the locations, the states, but we're changing the tax parameters to see how they vary. And this really helps us understand a little bit better what some of the sore thumbs are in the current Montana system. And now what you'll hear today that you haven't heard before is that we'll use this to talk about how some selected tax reform options might improve the competitiveness of Montana, using this same model of hypothetical taxpayers. There are the states, competitors: Colorado, Idaho, North Dakota, Utah, Washington, and Wyoming. Those states were selected in consultation with the Chamber. The industries were also a smaller pass-through manufacturer, metal fabricator, fairly good size C corporation, food and beverage retailers, credit card processing, which was our example of a financial services company, wholesale drug distributor, and data processing, or the information services example. Again, holding the financials constant, putting them down in every state, we applied the state statutory tax system. And one of the things we generated in that exercise is something I haven't seen in the analyses of Montana before, and that is, what do the effective property tax rates really look like on a new investment? And so what we did, we took the company, we expanded them by 20% in each of the states. All the payroll, additional payroll and property went into those each state. And then we calculated their property taxes, their corporate income taxes, sales tax on business inputs, the B&O tax in Washington State. And so all those things are added in, but in the first step, we generated effective tax rates for the property tax. And what you see is how unusual the Montana system is. We calculated a single effective tax rate, which is property taxes divided by the assets that are put into place with the economic expansion. And you can see that they range from 1.86% in Colorado for the manufacturers, the industrials, down to a low 0.66 in Wyoming. But Montana has a range of 1.15 to 1.76%, because the larger manufacturing example, the fabricator, is big enough to be hitting the tiered progressive property tax rates in Montana. And that pushes their tax rate up to 1.76% on the marginal investment, whereas the smaller manufacturer, staying down in the first tier of the property tax, has a more competitive 1.15% rate. And so you can see right away the inherent inequality, I guess, or discrepancies in how Montana treats investments of different sizes depending upon the current level of assets within a company. And that, as I say, is a unique feature. The commercial rates show that there's maybe less of a variation on the commercial side. Those are the retail, wholesale, service industries. But you still see Montana with relatively high effective tax rates. And the progressivity there also, but significantly less important. And you've got that progressivity in the class rates in addition to 15 categories, 16 official categories of class rates, one of which isn't being used apparently, so there are only 15 actually in effect, but you still see the results according to our effective tax rate calculations, looking at only the property tax.
And Bob, I guess one question there, looking at this slide, while Montana may seem fairly competitive with respect to, say, Colorado and Idaho with respect to these rates, there still is some administrative cost built into this complexity, and which I just think is also reflective in this, is that this is a more complex system than perhaps is necessary.
It is as complex as the system in Minnesota was when I became tax research director in Minnesota. When I saw their property tax system, I said, I've seen it all now. There's nothing like it in the rest of the world. And now I know more about Montana. And they're very similar. I don't know if the same people moved from Minnesota to Montana, if they were Norwegians or who they might have been. But for some reason, both states ended up with terribly complex property tax, classified property tax systems. And what happened in Minnesota, I don't know if it's true in Montana, is extremely politically unstable. Not only are you pushing those rates high in order to make up for the missing leg of the three-legged stool, it opens up the possibility in every legislative session to alter the relative class rates of the property tax system. And usually when they alter those rates, it's not good news for the business property tax payers.
All right.
All right. Quickly telling you things you already know. Lying in the background of the competitiveness analysis are the variations in the statutory tax rates for the individual income tax, the corporate income tax, corporate rate at 6.75%, ignoring the 7% on those that choose water's edge taxation of the corporate income tax. But so the rate's high. Certainly high relative to your competitor states. But the third column is the one that Nikki's already pointed to as even maybe a more important consideration from a competitiveness perspective. Do you want to just comment on those apportionment percentages?
Sure. So what these apportionment percentages represent is, as I mentioned earlier, Montana has a 3-factor apportionment formula, whereas several other states, 2 that we considered in our analysis, Colorado and North Dakota, have what's known as a single sales factor apportionment formula. So, and what this really does is it just imposes a larger burden on your in-state companies when it comes to their apportionment formula. When you make a company only consider their sales, what happens is out-of-state businesses selling into Montana, their apportionment formulas go up because before, or with a 3-factor formula, they will offset some of those sales by their property and payroll that is outside of the state. whereas your in-state companies that are doing a lot of exporting will have a higher apportionment formula because they've got to consider their property and payroll in the state, and that increases their formula, whereas they don't have as many sales here to kind of level that out. So at the current snapshot is that about 2/3 or more of the states have moved from this three-factor formula to single sales. This trend began in probably the 90s. Back in the 70s, it really started with one or two states doing it, and then it really started to pick up steam in the mid-late 90s, and really the trend has been in that direction, with most states moving in that direction. And a state like Utah, actually, they have an election for single sales factor. So there are even states that will allow their in-state companies to decide whether or not they want to do that. So definitely a trend.
All right, moving on, picking up the pace. Enough, we don't have to say much about the sales tax. You have no sales tax at the state level. Most every other state does, all but 5. But the average state rate is roughly 5%. If you wanted to use a number and ask, well, what's the average unweighted sales tax rate at the state level in the competitor states, it's 4.9%, round that off to 5. It might be easier to remember that. So what did we find out when we did the competitiveness analysis? I'll just briefly summarize the results. These are ratios. So for example, this second column says for the metal fabricator, if they locate in Montana, the same business, and expand it, versus Colorado, the second column shows a 125% figure. That means that Montana taxes, all the business taxes we calculated, are 25% higher in Montana than Colorado. Look down the column for the metal fabricator. Every Montana's higher than any other of the competitor locations. The same is true for the credit card processor. And these high rates are a combination of high statutory rates, progressive property taxation, and a three-factor apportionment formula. Just in passing, 56% of those cells, 56% of those percentages are higher in Montana than in the competitor states, more than half.
All right. So now we're going to talk about some of the tax reform options that were considered, and we would really just note here that these are ideas that came about from discussions with the chambers. Neither Bob or I are here to tell the state of Montana what it should or shouldn't do. And especially working in the number of states that I do work in, I will just tell you, you guys all have your own special issues, and they are all challenging. So you often make my brain hurt just trying to keep them all straight. But we did come up with some incremental tax reform ideas, which we'll discuss, as well as some broad reform options. So, Bob, did you want to comment on any of those in more
just
detail?
Briefly, we've already highlighted or set the stage for this. Business equipment property tax relief is probably a significant incremental reform, as well as maybe a foundation for a broader reform. Corporate income tax improvements, like trying to make consistent the idea that you should have a destination sales factor, because you're putting heavy weight on sales in the apportionment formula. So going away from a equally weighted to 100% destination sales apportionment formula.
Yeah, and on that note, I would remind you or tell folks in the room, if they don't already know, during your prior legislative session, Montana already went to market sourcing for purposes of determining that sales factor. You guys have kind of put the cart before the horse. What the progression was in most states was to go single sales factor and then market sourcing. And the first time when I saw that legislation, I said, I didn't realize Montana was a single sales factor state. And somebody said, well, they're not. And I said, well, that can't be right. But so you've already actually done the hard part, because the market sourcing piece is the more challenging piece of this. So that's definitely something to think about. And then one other sore thumb, especially for multi-jurisdictional taxpayers, is your tax haven blacklist. Montana is now the only state that maintains a blacklist. Oregon repealed their blacklist this past year. So that's something else that should definitely be considered, and is again, with dealing with federal tax reform issues and your rolling conformity, it's a perfect time to really think about that policy and determine whether or not it still makes sense.
I'm a simple guy. Can you explain that a little slower? What's a blacklist?
The blacklist?
Even the stuff prior to destination sales?
Sure.
Okay.
Yes. So for multi-jurisdictional taxpayers, if you're doing business in multiple states and you have $100 of income, you've got to determine how that $100 of income gets split up amongst the states that you're doing business in. The way that many states now make that determination is they use a single sales factor apportionment. So all they look at is if you had $10 of sales into Montana and $100 of total receipts, then 10% of your apportionment formula would be 10% of that $100 of income would go to Montana. You apply your rate by it. Montana still utilizes this 3-factor formula, which not only do you consider your sales, but you also look at where your people are, your payroll, and your property. And so what the 3-factor formula does is it places a greater burden on your in-state businesses that have people and property here. And so one of the ideas that Montana could consider is moving from this 3-factor formula to a single sales factor. The other item I was talking about was called market sourcing. And what that has to do with is how you determine where a sale is. And market sourcing generally applies for service industries and intangible property. So if you've got, if you're selling a widget into Montana or Idaho, I know where that widget is. If you've got an accountant sitting in Idaho selling services into Montana, that can be more challenging. So this market sourcing says, no, we're going to make you look to where essentially the customer sits, or where were those services consumed. And so Montana has already gone down that path with market sourcing. That idea is generally coupled with single sales factor apportionment.
Does that help? I have to listen to these explanations myself over and over and over again, because all the pieces have to fit together in a very complex way.
And I will be happy to explain what the blacklist is to anybody, but just so we can get to the real meat here, I'll pass on that for now, but I will gladly explain that.
And during the questions and answers, I'd be glad to talk about my experience in working at the OECD in Paris, where they created that list of countries. And we'll probably never, ever update that list of countries. So let's talk about some of these broader tax reform options. See, did I go the wrong way?
I think we went backwards.
Often I do that. I go backwards. But that's how tax reform works. It's not necessarily a linear process. All right. Keep in mind what we said in our overall report that we gave to the Chamber about our perspective on Montana, where you are and where you might go. There are some objectives, I think, that you might lay out in working with the legislators about what you'd like to accomplish. What are some of those? What would you like a reform package to do for you? One, reduce the burden on new investment, increase the attractiveness and capital and productivity and wages in Montana, reduce tax volatility. The numbers in our report say over about the last decade, the corporate income tax annual changes varied from a negative 43% drop to a 33% increase over 10 years on an annual basis. The oil and gas tax rose 49% one year and went down 49% in 1 year and went up 35% in 1 year. That volatility has got to be reduced. A consumption-based tax based upon what people spend from day to day in one form or another would be a much more stable source of revenue. Collect additional taxes from out-of-state purchasers, that could be tourists coming into the state, or it could be businesses selling into the state. It's to increase the balance between revenue from the out-of-staters and revenue paid by the in-state hometown team. And again, one we really haven't talked about that might not be higher on your radar is increased uniformity among types of businesses. What we know from the evolving economy is going to be increasing non-corporate taxpayers and industries. It's more difficult for legislators to pick winners and losers in terms of targeting tax policy. Try to create a future tax system that's neutral as to how you form your business, what kind of, whether it's partnership, C corporation, whatever the legal form might be, try to treat them more uniformly than you currently do. We were asked to look at the potential revenue impact of an alternative, two alternatives for broadening your tax base by finding the missing leg of the stool. We looked at, one thing we did, we were asked to look at property tax reform options too, which included repealing the business personal property tax. A second option, equalize property tax class rates across between residential and industrial and commercial property. A single class rate for all types of property. And so here's quickly what we found. If you did and that would be equalized at a current rate of 1.35%, which is the class rate for residential property. The next slide shows you what we found. Eliminating business and utility personal property taxes is a big number. It would reduce total property tax revenue by $235 million a year. It'd be a 33% reduction in business property taxes, so 1/3 of the total business property taxes are coming from personal property. The rest is real, buildings and land. It'd be a 15% reduction in total property taxes. A significant amount, a chunk of that is from utilities. Perhaps 2/3 of that reduction would be utility-related property because it's so heavily taxed today in Montana. Next slide. What do we find out about equalizing property tax rates? Now, this exercise assumes that you have not created you have not eliminated personal property taxes. They're still in the system, but now personal property for business as well as real property is taxed at this uniform 1.35% class rate. Another big number, bottom of the third column shows that the business property taxes would be reduced $412 million a year. That'd be a 57% reduction in property taxes. Those numbers are to illustrate how significant those property taxes are. It's not to say that the legislature, that we are recommending the legislature consider such a change, but it's to give some insights into how large the property taxes on business are and what the cost might be of a significantly more effective or attractive, competitive business property tax system. Equalizing the property tax rates was another option that I mentioned. If that were done, the revenue loss would be $412 million a year. And the revenue loss for non-utility property from non-utility property would be $100 million a year. Again, these are not numbers that you may have seen these numbers elsewhere in the Montana debate about property tax reform, but we wanted to make sure that you had kind of our take on the dollar magnitude of those changes. All right.
All right, drum roll.
Let's go.
Here's
Let's sprint to the end.
This is the big news. We
All
tried
right.
to be out of time, but unfortunately.
All right. So states, there are really three ways states tax consumption today. The traditional retail sales tax used in 45 states, Gross receipts taxes used significantly, really only in 2 states, Washington State and Ohio under the CAT tax. And then there are these entity level taxes. They look like income taxes. Say, think corporate income tax, but the base to be calculated is value added for the business. That's basically the total revenue of a business minus its purchases from other firms. Alternatively, it's the money left over, that difference can be used to pay labor and capital. So it could be also thought of as payments to your inputs. The important thing about that type of entity level tax using a consumption base is that it eliminates the pyramiding under the sales tax. The biggest negative of the sales tax is so much of it falls on business inputs. A little bit later slide, which we might not be able to talk about more fully, is that we estimate when we did a sales tax model for Montana that about 34% of the total sales tax would be paid by business on business inputs. You don't want to do that. If you can avoid it, it's extremely difficult to avoid it under a retail sales tax. This tax would allow the subtraction of purchases from other firms, so that additional tax on inputs or pyramiding would disappear. It's an important difference between a retail sales tax and this we're calling a business activities tax.
And Bob, it turns out these people love listening to economists, so they've given us a little extra time.
An hour? Do we get an hour more?
I heard 3. No,
Okay.
not quite.
So the retail sales tax option, we started kind of with the Idaho example, which gets big high grade from cost on being a good sales tax system. We took their features, we debated it, we talked about what a better system in Montana might look like. The new system that we estimated a revenue impact for assumes that the big trade-off is handled the following way. The big trade-off is the fact that if you want more revenue from the sales tax, you've got to tax business inputs and services. There's no way around it. But if your economic objective in being more competitive is to not tax business more heavily, it's a contradiction. It's a tension. It's a very, very significant tension in the design of a sales tax. What we did, we said, let's try to address that. So this alternative of the sales tax taxes very little services at all. Not because consumers shouldn't be paying the sales tax on their beauty and barbershop visits. It's that you can't deal with the lawyers and the service inputs purchased by business. You can't differentiate between consumers and businesses effectively, administratively, and so they're either in or out, both for households and business. It cuts the size of the base, but helps to protect businesses from not being taxed on their business inputs.
And the other thing I would add about that for the policymakers in the room is this has been a large topic of conversation, the taxation of services under traditional retail sales taxes throughout the country for the last several years. And because often a legislator will think, well, we have to expand the base. We can expand the base and lower the rate. As Bob said, if you include services, a major chunk of services are business to business services. And just as a quick story of how quickly one of these ideas will go down in flames is Washington, D.C. tried to do it right. They were going to impose sales tax on consumer services. Within, I think, a week or two, it got called the yoga tax because these are the things that were going to be subject to tax. Yoga, gyms, golf, getting your hair cut, getting your car washed, and they were trying to exclude business services. And there was very quickly an outcry from the voters because they didn't want their yoga taxed. So this is an area where it often comes up, and it's kind of a little blip on the legislative calendar in many of the states I work in, and then it just kind of fades away.
So what is the sales tax base of this hypothetical sales tax for Montana? Broad base includes most consumer products, the tangible products consumers buy, excludes most business purchases of both tangible and intangible, but we tried to minimize the tax on the business purchases of inputs with some success. It exempts most purchases of services, both for businesses and households, except that it includes utilities consumed by households, but not utilities consumed by business. It exempts sales to nonprofits and government. Motor vehicles purchases are subject to the tax in this hypothetical. Housing is exempt, your owner-occupied housing. It exempts motor fuels, tobacco, and alcohol purchases, and it exempts drugs and medical equipment. Medical services are already exempted under the general service exemption. What does that do as a revenue source? On the next slide, we impose the 4% constitutional limit on the state sales tax if Montana had a state sales tax. And it wasn't until I was working on this sales tax model, I plugged in the average rate for the competitive states, like 5%, and immediately the chamber asked me to please address that inconsistency and error. It's a 4% maximum rate, so we ran the model at 4%. Tax revenue at an annual level would be $886 million a year. But if you look at how it's distributed, we wanted to divide it between household consumption that's taxed and business inputs that are taxed. Even with our efforts to exclude business inputs from the tax, our results indicate that household purchases will pay 66% of this hypothetical sales tax. Businesses will pay 7% on their capital purchases, primarily because of what happens in the construction industry and the difference between production processes and other equipment purchased by business. You got to draw these lines in putting together a sales tax, and 27% of the sales tax will come from intermediate business inputs that the general regulations and laws in other states have not been able to remove from the sales tax base. So when the dust settles, 2/3 of this base set taxes are paid by consumers. 1/3 is still being paid by business, which is better than the U.S. average of about 40% being paid by business. So that's a reminder of what a sales tax, sort of an insight into what a sales tax might look like in Montana at a 4% rate. The other option is the one that's been called a business activities tax, an entity level tax, not based upon day in, day out transactions of sales to final consumers. It's based upon your books and records at the end of the year. You may pay quarterly payments, but it's your total revenue minus your purchases from other companies, with a long list of what we mean by total revenues and a long list of what is a subtraction in terms of purchases from other firms. There are a lot of details that have to be worked out in terms of, for example, how to handle agent-principal relationships. If you're an insurance agent collecting money for the principal of the insurance company, whose revenue is that in total revenue? So you really need, it takes a lot of work to design it correctly, but the base is total revenue minus total purchases from other businesses. It includes all forms of doing business, no differentiation between C Corps and pass-through entities. Everybody's in it together. What other states that have done this have found, and that's New Hampshire with their BET tax, Michigan with a single business tax, and different variations on the theme, is that it creates a political solidarity among the business community. It's very difficult for the legislature to increase the rates on these broad-based entity-level consumption-based taxes because every form of doing business rises up in opposition. It's not the C Corps versus the pass-throughs. Everybody's in it together. So our revenue estimate includes all forms of doing business. It's apportioned, as Nikki explained, with 100% destination sales apportionment factor, which means that it's operating as though it's a destination sales tax concept. If you sell out of the state, those sales are not do not generate the tax base in Montana. If you're selling into the state, your sales will generate tax base and taxes coming into Montana. I think that describes it accurately?
Yeah, and I would say the big difference is to keep in mind between a traditional retail sales tax that Bob talked about first, is that this is a tax determined on a transaction-by-transaction basis. So any sale within Montana is going to be subject to this tax kind of at the point of sale. This value-added tax base or business activity tax is determined more in the fashion of the corporate income tax, where you do that on an annual basis by totaling up all your revenues less your purchases from other firms. And then the reason we're still talking about this apportionment thing, which I know, unless you're a state and local tax practitioner, you don't want to talk about apportionment, but the reason you've got to talk about it here is because you're going to be totaling up your national sales less your national business inputs, and that tax base has to be apportioned to Montana. So you're going to look at those sales into Montana to capture the Montana consumption piece. So those are two of the distinguishing factors.
And in contrast, under the sales tax, states develop complex rules for determining where a sale takes place. And now they're using destination concepts. It's where the consumer uses the good or service subject to the sales tax. And to achieve a similar objective under this BAT, entity level tax, apportionment has to serve the role of allocating the tax base to Montana. Well, let's skip the detailed numbers, I think, in terms of time.
Sure.
We did different versions of this, comprehensive base and maybe a more typical base where you exclude healthcare, for example, and don't try to apply it, or you don't apply it to insurance and real estate, financial services and insurance because of the complexities involved. We looked at if you did the comprehensive base, this is the next slide, a comprehensive BAT would raise an estimated $298 million annually at a 1% rate. Now, I think the current corporate income tax at 6.75% is raising a little less than $200 million a year. At 1%, this tax could raise $298 million on a comprehensive basis. It's because it's so big, it's applying not only to C Corps, but to pass-through entities, and it's applying to all industries except for selected industries for administrative purposes or kind of social objectives like not taxing education. When you exclude from the tax base some of these typical services, industries that are excluded, the typical tax base at 1%, the revenue drops down to $219 million a year, which is approximately the corporate income tax collection at 6.75%. So it's not to say that 1% is the rate you should use. There are some limitations probably from an economic competitiveness perspective on how high that rate could go, but it was just trying to choose a rate, 1% here, and then it gives you some idea what the magnitude of this is. Let's look then finally, maybe we can come back to a further discussion of the differences between the sales tax and the BAT tax. But let's look finally, using that competitiveness model that we talked about earlier, what happens if you were to put a reform package in place? So the Chamber asked us to look at a reform package that eliminates business personal property taxes, equalizes the real property tax at the 1.35% rate like residential property, adopts a 100% destination sales apportionment formula, and we looked at Package 1 and Package 2. Package 1 was financed by a 2% BAT. Package 2 was financed by a 4% retail sales tax using the constitutional limit in Montana today. Well, look at this chart to see what I think a significant, I don't know if you want to say dramatic, but this type of reform, the Package 1 is revenue neutral. And what Package 1 says that if you had a revenue neutral tax change, currently the ranks, remember there are 7 states in total, 1's the highest tax, 7's the lowest tax in this comparison. The current tax rankings have Montana #1 for metal fabricators, credit card processing, and then 4, 5, and 6 for one example for all the others. Package 1 with a BAT rate of 2%, which is revenue neutral, not raising or lowering taxes in total, would move Montana to the bottom, the lowest effective tax rate among the 7 states for 3 of the industries, 6 for one, and higher rankings though for 2 others, the retailers and the drug distributors, the wholesaler. And that is because the reason why the others drop down to 7 or 6% is because the model shows the importance of going to 100% destination sales factor apportionment for the corporate income tax is a significant determinant of how you end up here. And with the food retailer, we put 100% of their sales in Montana and every other state, and for the wholesaler, we put 50% in state. So they got much less benefit from changing the apportionment formula. And then you combine or put on top of that the BAT tax. So you're beginning to see in these ranking changes some story that's unfolding about how it could improve the competitiveness of Montana, but given the apportionment formula and the other factors, it won't affect every industry equally. There are going to be some more significant winners than others, even if it's a revenue neutral change. And economic modeling we've done in a number of other states, but not in Montana, suggests that whenever you shift from a tax on property and income to a tax which is more based on consumption, you end up with higher real economic growth, even if the change is revenue neutral. In our final 1 minute, package 2, which was the sales tax, achieves similar results for moving down to number 7, 4 of these industries, because we tried to shield business inputs from the sales tax. But if you can't hold that in the legislative arena, then you couldn't generate these kind of results. But you still have the food and the drug distributors, food retailers down at 6. So we think that reform, even if it's revenue neutral, but this second package was not revenue neutral. It actually raised about $400 million, I believe it was, because we used the 4% rate. Could be much lower than that to be revenue neutral. End of story is that there are real advantages in terms of uniformity, more stability, more uniformity across industries and types of businesses, greater competitiveness and incentive to invest and create additional productivity in Montana. If you think about an alternative tax system that relies more heavily on consumption taxes, we've tried to show that the retail sales tax is not the only game in town. The BAT is another possibility. I know you've been more than patient, and we've taken up perhaps time that other people, we don't want to steal from their time, but we'll take your guidance on whether we answer your questions on the side or whether we try to do that now.
If there's any burning questions, I think we can take like 1 or 2. I know we're cutting into a little bit of a networking break, but you can still get a solid 20 minutes, even with a couple questions. So, yeah, Todd, did you have one over here?
Yeah.
Start? Okay, who else? All right.
Let me just say, Tom Newbig sends his regards. He had a choice of coming here in January or going with his daughter kayaking off the coast of Mexico, and he decided to be not in Montana.
Hi, Nikki.
Hello.
My question is related to your thoughts on taxing intangibles, how that fits in. That's not really something you explored throughout this, but that's something Montana's considering right now. So I'm curious on your thoughts on the volatility versus stability argument that you're putting forward here and how that could fit into this formula or not.
And before I answer, I have a question. So when you say Montana's considering taxing intangibles, what is that related to? Is it having to do with the corporate income tax? Or
Property.
property tax?
Yes, thank
got
you.
it. Okay. Okay. Well, the taxation of intangibles in the property tax realm is kind of a can of worms. Oregon is a state where for certain taxpayers, intangibles are included in their property tax valuation, and it it definitely results in significant litigation, and it more creates a more unequal playing field for certain industries. So I would definitely caution folks on going down that path, because the trend really has been the other way, and that would put Montana in a bit of an outlier situation if they moved in that direction.
I will note that the states that are using this value-added tax base, a consumption base for the entity-level tax, we're calling the VAT, do tax the returns to capital as well as the payments to labor, and what is included in the value-added base is any value added that's created by the use of intangibles. And so it's in the base, but because it taxes all consumption, services, tangible products, as well as intangible income that's thrown into the base, it's a much, much more stable base. In fact, we worked on the development of the CAT tax in Ohio and did the revenue estimates in 2005 of how much revenue it would raise. And in 2010, even despite the deep recession, that revenue forecast 10 years earlier was within 5% of the actual number. It's easier to forecast because it's a much more stable base, and it's not going to vary 10% or 20% from year to year. It might vary 2% to 3% or 5 at the most. But so I'm not worried about the volatility if, in fact, the value added does include the return to intangibles.
And I think this is a particularly technical question, so we can talk about that more offline. But there are different ways you can include it in the base of on the business activity tax side, and that is just more of a policy choice that the state would want to go down. But it would be in that base number, and really the question is who will be paying it.
I would
Yeah.
like to thank Bob and Nikki for sharing with us this important study. Let's give them a round of applause.
Thank you. Thank you for helping me.